Welcome to the Deep Dive. Today, we're tackling a real heavyweight in the crypto space, XRP.
It's definitely an asset with let's say, a profound identity crisis.
Absolutely. It has a decade of history. It's got this powerful corporate backing from the company Ripple, a huge community of advocates, and yet
it's constantly facing skepticism about its real-world use. And, well, until pretty recently, it was stuck in this massive regulatory gridlock.
Exactly. So our mission today is to cut right through that noise. We've gone through the sources to frame this deep dive around three really critical areas.
First, we have to disentangle the monumental confusion over what XRP actually does versus what the company that created it, Ripple, does. They are not the same thing.
Not at all. Then we're going to get into the game-changing regulatory clarity we finally got after that, almost 5-year SEC lawsuit.
And we'll track how that clarity immediately translated into institutional demand, specifically the launch of spot ETFs.
And finally, we'll wrap things up with a really academic look at the asset's volatility. We found this fascinating study that used machine learning models to try and predict XRP's price.
And it reveals some pretty surprising insights into its market structure, which will contrast with some of the more traditional institutional valuation models.
So our goal is simple: to give you a shortcut to understanding the complete picture here, the fundamentals, the market performance, and the potential future, all without getting bogged down the hype.
Right, so let's start with the absolute basics, the vocabulary. This is, I think, the single biggest source of confusion for, the media, the market, everyone.
You really have to distinguish between three main components.
First, you have the XRP ledger, or XRPL.
Right. That's the technology itself, the decentralized public blockchain.
And it's built for one thing, really: speed. It's engineered to settle transactions incredibly fast. We're talking about 1,500 transactions a second with finality in just 3 to 5 seconds.
Then you have XRP. That's the actual digital asset, the coin that lives on that ledger.
And it has a few key jobs. It's used to pay tiny transaction fees, which get burned. It acts as a reserve to prevent spam on the network. But its main design, its whole purpose, is to be a bridge currency.
And lastly, part 3 of this puzzle is Ripple.
The private company, the one that developed the technology, still controls a huge chunk of the XRP supply and sells the financial products that run on top of the XRPL.
And understanding Ripple's product line is, I think, the key to understanding XRP's whole adoption problem.
Yes, the adoption reality is really where the rubber meets the road. Because Ripple offers a suite of products, but only one of them actually creates any demand for the XRP coin itself.
Let's break that down. The main offering, the one most of the big banks and financial institutions use, is called RippleNet.
This includes their software solutions like Xcurrent and Rippia. It's basically a blockchain-based network for real-time gross settlement.
And here's the most important takeaway from this whole section: RippleNet
Does not require the use of XRP.
At all. This is the essential fact check. When you see headlines about huge companies, American Express, Bank of America, Santander, PNC partnering with Ripple,
they are almost all using RippleNet only. They get the benefits of the fast technology, the efficient settlement, but their usage does not generate any buying pressure or demand for the actual XRP coin.
So if RippleNet doesn't drive demand for the coin, what does?
That's where we have to look at their other product, On-Demand Liquidity, or ODL.
This is the only Ripple product that really uses the XRP coin as that bridge currency we mentioned earlier.
Right. ODL is designed to solve one of the biggest headaches in global finance, which is liquidity management.
You mean how banks have to keep huge piles of money in accounts all over the world?
Exactly. They have to pre-fund accounts in dozens of countries with local currencies, which means massive amounts of capital are just sitting there idle. It's incredibly inefficient.
And ODL is supposed to fix that.
It eliminates that need to pre-fund. So instead of holding idle cash, a company can use ODL to send, say, US dollars. That gets converted into XRP instantly.
The XRP zips across the ledger to another country.
Instantly. And it's immediately converted back into the local currency, say Mexican pesos, on the other side.
So you get real-time settlement without tying up capital.
That's the value proposition. And the true confirmed utility and demand for XRP comes from companies using ODL. We're talking mainly about remittance providers like Tranglo and SBI Remit and Ripple's own liquidity hub.
So if you zoom out, the entire investment case for XRP really boils down to this one question.
Can Ripple get institutions to transition from just using the network software, RippleNet, to actually using the coin itself for cross-border settlement with ODL?
Because until that shift happens at a huge scale, the price is mostly going to be driven by speculation and hype, even with fast tech underneath.
And that leads us perfectly into the biggest source of that uncertainty, the thing that hung over this asset for half a decade, the SEC lawsuit.
The sources detail that this long, drawn-out legal battle finally wrapped up in August 2025. And the clarity it provided it's profoundly changed the landscape for XRP.
It was a landmark moment for the whole crypto industry, really.
The U.S. District Court came out with a ruling that XRP is not a security, but with a very important catch.
Right. It's not a security when sold in public, retail transactions. That ruling basically gave the green light for exchanges and everyday investors to trade XRP freely in the U.S. again.
But it wasn't a total clean sweep for Ripple, was it?
No, not at all. The court was very clear that certain direct institutional sales that Ripple made in the past, those were classified as unregistered securities transactions. And that nuance is extremely important.
Okay, but that brings up a critical question. The final settlement had Ripple paying a $50 million fine. That's a huge reduction from the SEC's initial ask of $125 million, but it's still $50 million. How is that seen as a massive win?
That's a fair challenge. The way the sources frame it is that the payment relates purely to those past institutional sales practices. The win is about the legal clarity moving forward.
So the penalty was for how they raised money in the past, not for what the asset is today.
Exactly. The court gave everyone a clear roadmap. The asset itself isn't a security when you're trading it on an exchange. And that clarity immediately unlocked years of pent-up institutional demand.
And the market responded, almost instantly. U.S. asset managers who had been waiting on the sidelines for this exact moment moved right away to launch spot XRP ETFs.
The debut of the Canary Capital XRPC ETF on NASDAQ in November 2025 was explosive.
It was the biggest ETF debut of the entire year. It posted $58 million in day one volume.
And to give you a real sense of the institutional appetite here, that launch pulled in $245 million in new creations on its first day.
Which is just incredible. That's nearly 4 times the debut inflow that the Solana ETF had. It just shows you how much demand there was for a regulated way to get exposure to XRP.
And here's a fascinating counterpoint. Despite all that institutional excitement, XRP's spot price showed a classic sell the news pattern.
Right. It spiked like crazy from the mid $2.30 range up to $2.50 on the news.
And then immediately retreated about 7% within hours.
That kind of whipsaw action really shows you that while institutional access is a great long-term signal, in the short term, big holders often use these big announcements to sell their positions.
It's the market normalizing after a big speculative run-up.
So to understand that supply side of the volatility, we should probably spend a minute on XRP's tokenomics because they're pretty unique.
Very unique. Unlike Bitcoin or other mined assets, XRP has a fixed total supply, 100 billion tokens. No more will ever be created.
And the mechanism that governs how many of those are in circulation is this escrow system.
Right. Back in December 2017, Ripple took 55 billion XRP, that's more than half the total supply, and locked it all up in these escrow accounts.
And the system is designed to be predictable.
Very. Up to 1 billion XRP is released from that escrow every single month. But, and this is key, Ripple almost never uses that full amount.
They use a fraction for sales, for expenses, for incentives.
And the sources confirm that generally somewhere between 70 to 80% of whatever is unused just gets returned to the escrow. It's locked up again in a new contract.
But this whole system has been a major point of criticism from investors, hasn't it?
Oh, absolutely. Critics argue that because Ripple controls almost half the supply and is a consistent, predictable seller every month.
Releasing tokens whether the market is bullish or bearish.
Exactly. They argue it creates this perpetual downward price pressure. It's a constant headwind that independent investors have to fight against.
It's a valid criticism for sure, but there is a counteracting dynamic built into the ledger itself.
The burn mechanism. It's a tiny amount of XRP, something like 0.00001 XRP, that gets permanently destroyed with every single transaction fee.
And while the current annual burn rate is tiny, The sources estimate it's around 0.00075% of the total supply. The long-term effect is all about scale.
Totally dependent on scale. I mean, if ODL adoption really takes off and the XRPL sees a 100-fold increase in transaction volume,
Suddenly, that burn rate jumps to a much more significant 0.75% annually.
so the tokenomic structure gives you this duality. You have short-term headwinds from the escrow, but massive long-term deflationary potential if, and it's a big if, institutional adoption really accelerates.
Okay, let's pivot away from fundamentals and supply, get into the technicals. Specifically, predictive modeling. We found this incredibly comprehensive academic study.
Yeah, this was great. It compared 11 different machine learning and deep learning models to see how well they could predict the closing prices of various cryptocurrencies, including XRP.
And what was the big takeaway?
Well, the general finding was that there's no silver bullet. No single model works best across all crypto assets. For many of them, classic models like XGBoost and Random Forest were actually very robust.
But XRP was different.
XRP stood out. For predicting its price specifically, the complex deep learning algorithms, we're talking convolutional neural networks or CNNs, recurrent neural networks, and LSTMs, they showed the best performance.
They had significantly lower error rates compared to the other models.
And to put that into context for you, it's interesting why that might be. Traditional models like XGBoost are great at figuring out which inputs matter most. But CNNs, and especially LSTMs, they're designed to process sequential data. They're amazing at spotting patterns in sequences over time.
So the fact that these models work best for XRP suggests its price movement is heavily influenced by these complex nonlinear patterns and sustained temporal correlations.
It implies a market structure that's maybe more complex or perhaps more systematically influenced than some other digital assets.
And then when you contrast those technical findings with the institutional valuation frameworks, you get the final piece of the puzzle.
Which is the massive range of future possibilities. Based on models like the capital asset pricing model, analysts are projecting just wildly different long-term price outcomes for 2030. And it all depends on utility adoption.
Let's start with the low end, the bear case.
The bear case assumes the asset basically fails to capture any real market share. The institutions stick with RippleNet, they never move to ODL. In that scenario, the price could collapse to around 13 cents by 2030.
13 cents. Wow. Okay, what about the middle ground?
The moderate bull case. This assumes steady, regulated growth, benefiting from the legal clarity and a gradual expansion of ODL. That model projects a price of around $12.70 by 2030.
And then there's the max case, the really optimistic scenario.
This one posits that XRP manages to capture a meaningful slice of the multi-trillion-dollar asset tokenization market,
which Statista estimates could hit $10.9 trillion by 2030.
So if that happens, this high-end projection sees the price reaching somewhere around $29.30.
That enormous range really tells the story, doesn't it? The risk has shifted.
It has. The legal questions are largely settled, but the economic questions, the ones about real institutional adoption, they are still wide open. And that is now the core driver of valuation.
This has been a really fascinating deep dive. We've covered the crucial distinction between RippleNet and ODL adoption.
And just to hammer it home, remember, those big bank partnerships you read about don't necessarily generate demand for the coin itself.
We tracked the regulatory clearance that uncorked all that ETF demand, even if the price action was a classic sell the news event.
And we learned that its unique market structure seems to require these really sophisticated deep learning models to predict its movements effectively.
What this all reinforces is that while XRP has cleared its biggest hurdle, the long-term success of this thing hinges entirely on one question.
Will global institutions move from just using Ripple's fast settlement tech to actually using the XRP coin for on-demand liquidity management?
So we'll leave you with a provocative thought to explore next. The XRPL is uniquely focusing its development on integrating built-in compliance features, things like decentralized identity and multi-purpose tokens.
These are features designed specifically to cater to regulated financial institutions and even governments. So you have to ask yourself, if the future of global finance is dominated by institutionally compliant tokenization platforms, will the XRPL's deliberate focus on regulatory readiness ultimately give it an edge?
Could that allow it to win a significant portion of that multi-trillion-dollar race against competitors that might be more decentralized but are also far less compliance-focused?
Because that difference right there, that's what separates the 13-cent scenario from the $29 outcome.